Hey friends, so there are a lot of different ways that we can invest in the stock market. And in my opinion, there is no right way to do it. And all of these different ways suit different types of people. So in this video, I'm going to go through 5 different ways that you can invest in the stock market so we can figure out which way is right for us. Which way should I go? But first, why is it even important to invest in the first place? Well, $10 in 10 years' time will not buy the same amount of stuff that it does today because of inflation, which means that every single year, our money loses about 2% of its buying power. What? $50 for a cup of coffee? Back in my day, I could buy a cup of coffee for $5. So if we leave all of our cash in a savings account, which pays 1% interest per year, it's not enough to keep up with inflation. And that is why it's important to invest. So if you like investing and compound interest and your money being able to make more money over time, make sure you smash the like button on this video and subscribe to this YouTube channel. And by the way, I'm not a financial advisor and this is not financial advice. So it is important that you do your research before you invest in anything or reach out to a professional if you do need help with your investing. So the first way that you can invest in the stock market is through micro investing apps. Micro investing allows you to invest small bits of money. Typically with full service brokers, they do have minimum amounts that you can invest. For example, $100 to $500. And the fees can be pretty high when you're putting money in and taking money out. But with micro investing apps, you don't need thousands of dollars to invest. You can start investing with $5. Really? I can invest with $5? And if you're new to the whole world of investing and it does seem a little bit overwhelming, micro investing apps can be a really great place to start. They can help give you a taste for investing and help you learn how the stock market works. Micro investing apps generally have a few set portfolios that you can pick from, so it takes the hassle out of researching different things that you need to invest in. So the pros of investing with micro investing apps is that you can invest with a small balance, and it's pretty low effort because with a lot of these apps, they do have set portfolios to choose from. So essentially all you need to do is transfer your money into the micro investing app and they invest for you on your behalf. And you can even set up automatic investments to take the hassle out of investing completely. Some of the things that we need to be wary of with micro investing apps is number 1, there could potentially be some higher fees for this convenience. So it is important that when we are researching different micro investing options that we do have a look at the fees, because these fees can eat away at our profits, especially if we do have a small balance. Something else to be mindful of with micro investing apps is there can be limited customization. Often when you do pick a portfolio in a micro investing app, there isn't a lot of ability to change the portfolio that you're with or even select multiple portfolios. Can I get a 4-cheese pizza? And make sure that it is vegan cheese. And I also need a gluten-free pizza base. Can I get that on 60% of the pizza? And for 18% of the pizza, can I get the cheeses on the side and some tomato sauce? And can you please make sure that when the pizza is in the oven, it is northeast facing. So these are some different micro investing apps that you can check out if you are in Australia. So there's Spaceship and Raise, and I do have affiliate links for Spaceship and Raise in the description below. And there is also ComSec Pocket. If you're in the US, some micro investing apps that you can check out are Stash, Acorns, and Public.com. So another way that you can invest in the stock market is through Robo Advisors. Essentially what a Robo Advisor does is they do ask you a series of questions about your personal financial situation and your goals. Hey Siri, how should I invest my money?
I cannot give you financial advice, but make sure you follow Invest with Queenie.
Robo advisors are a little bit like Spotify. You know when Spotify creates that made for you playlist and it takes into account the kind of music that you like and the music that you listen to, and then it creates a playlist of songs that it thinks will suit you. Well, that's essentially what a robo-advisor does. But instead of creating a playlist, it creates a diversified investment portfolio. It will ask you a few questions about you, such as how long you want to invest for, your financial goals, and your risk profile, so it can recommend a portfolio to suit you and your needs and your financial goals. These portfolios can be made up of a mix of different assets, for example, ETFs, bonds, cash, and gold. So the benefits of using Robo Advisors is they are very low effort. So you don't need to go around researching different investments to invest in because they will recommend a portfolio to suit your needs. Another benefit of Robo Advisors is they do manage your investments on your behalf. So they manage the rebalancing of your portfolio and ensure that it is well diversified. Some things to be mindful of with Robo Advisors is there could potentially be some extra fees since they are managing your money on your behalf. So it might be more expensive than if you were to go out and buy these ETFs by yourself. Another thing to be mindful of is sometimes there is limited customizations in the portfolios that you do have because they often have a few different portfolios set up which suit different types of people. And there might not be a lot of customization options with the portfolio that you have. So these are some different robo-advisors that you can have a look into in Australia. There's StockSpot, which is a robo-advisor that I have used in the past and am currently using. There's also SixPark, and there's also InvestSmart. And if you're in the US, a couple of robo-advisors that you can check out are Wealthfront, Betterment, and Interactive Advisors. So another way that you can invest in the stock market is through ETFs. ETF stands for Exchange Traded Fund. So instead of just purchasing one stock, you're purchasing a basket of different stocks. And ETFs are generally less risky than purchasing an individual stock. Most ETFs are passive, which means they don't try to outperform the market. And most ETFs do try to track the performance of an index, for example, the S&P 500 or the ASX 200. And ETFs do like to mimic the performance of an index. You can buy ETFs through brokers such as CMC Markets and Perla, or if you're in the US, you can use a broker like Robinhood. The benefits of investing in ETFs is you're not putting all of your eggs in one basket. Because you are buying a basket of different stocks, your risk is more diversified. If we buy an ETF, for example, that tracks the S&P 500, and let's just say, for example, Apple goes bust, that would suck a lot, but we still do have 499 other companies to fall back on, some of which might actually be doing pretty well. Oh no, it looks like the apples aren't good anymore, but it's a good thing I still have bananas and eggplant. Something to be mindful of with ETFs is we will need to also pay a bit of a management fee because these ETF companies are essentially purchasing all of these different assets on our behalf. And if we were to purchase every single stock on the S&P 500, it would be really expensive and time consuming. And having to manage rebalancing the portfolio every couple of months will also be very time consuming. So something we should keep in mind when we are looking into different ETFs is what the management fee is for each ETF. So these are the pros of investing in ETFs. The first pro is that it is diversified, so it's generally less risky than investing in individual stocks. The second pro is you can pick and choose your own ETF investments, so you can personalize your portfolio a bit more than if you were to go with a micro investing app or a robo advisor. The third pro is that they are low cost, especially when we compare it to something like a managed fund. They are also pretty easy to trade because we can buy an ETF like we can buy a stock on the stock exchange. And finally, ETFs are very transparent about their past performance, their fees, and what they invest in. And we can find out all of this information on the ETF provider website. Some things that we should be wary of when we are investing in ETFs is there is the potential for a particular market or a sector to go down. And since an ETF does track different markets and sectors, this is something that we should be keeping in mind. There is also currency risk as well. For example, if we are investing in an S&P 500 ETF from Australia, there is the chance that the Australian dollar could get weaker or stronger against the US dollar, and this can really impact our returns. There could also be tracking errors with ETFs, and there may also be liquidity risk with some ETFs. Investing in ETFs ourselves also does require a bit more effort than micro-investing apps and robo-advisors, since we will need to be researching which ETF to buy. And finally, we also do need to consider the management fees and also the brokerage fees when we are purchasing ETFs. So these are some of the biggest ETF creators in the world. So there is BlackRock and Vanguard, and if you are in Australia, you can also check out BetaShares as well. Another way you can invest invest in the stock market is through individual stocks. Individual stocks are usually more risky than ETFs because they are less diversified. However, if you do know what you're doing and you know how to research different stocks before you purchase them, you could potentially get even better returns than an ETF or the market index. And investors who do like to invest in individual stocks are typically looking to outperform the market. Time to make those gains by researching some stocks. However, with the potential to have greater returns, also has the potential for greater risk as well. So it is really important that we do know what we're doing before we start investing in individual stocks. So these are the different types of individual stocks that you can purchase. The first one is blue chip stocks. And these are companies like Apple. They are well-established, stable companies, and they suit investors who want steady returns and not as much risk. Then there are speculative stocks, which are more suited towards experienced investors who are willing to risk their capital for a potential greater return. There are also dividend stocks, which are typically blue chip stocks, and this can provide investors with passive income. And then there's also growth stocks, which are typically smaller companies who prefer to reinvest their profits back into growing the business than paying out a dividend to their investors. Growth stocks do have the potential to have greater returns over time, but they also do have the potential for greater losses as well. So these are the pros and cons of investing in individual stocks. The first pro is you can potentially get higher returns than an index. Another pro is you can customize your portfolio and pick and choose which companies you would like to be added to your portfolio. However, some cons of investing in individual stocks is it does have the potential for greater losses as well. Oh no! I lost all of my money on this speculative stock. Pablo's gonna kill me. You will also need to put in a lot of effort into researching different companies. And if you would like to get started in learning how to research individual companies before you invest, you can watch this video up here. And I also have created a stock research checklist, which you can check out in my description below. And the final way that you can invest in the stock market is through a managed fund. When you invest in a managed fund, your money is essentially pooled together with other investors. And then a fund manager buys and sells assets on your behalf. The pros of investing in managed funds is they're typically low effort. You can also get pretty well diversified managed funds. And finally, you can have the potential for greater returns, but also the potential for greater losses as well. Some things to be mindful of with managed funds is there's generally more fees than if you were to invest in a passive ETF. Another con is there is limited customization and control over your portfolio. And another thing to be mindful of is it could underperform the market. So whenever you are considering to invest in a managed fund, it is really important to consider all of these different factors. So those are 5 different ways that you can invest in the stock market. Thank you so much for watching this video all the way to the end. I have a secret code word for you, which is headphones, as in I'm wearing some noise cancelling headphones and I'm probably speaking really loud right now. So write me a comment below with the word headphones in it, just so I know who watched this video all the way to the end. I really appreciate you. If you like this video, make sure you tap the like button and subscribe to this YouTube channel for more content about investing and personal finance. And I will see you in the next video. Bye! And if you want more content, I got you. Here are some more videos that you can watch, so make sure you click the links and click through to another video.